Hello and welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is Tuesday, July 16th of 2024, and we're going to go through the three topics we're paying attention to that are moving markets, so you should be too. Thanks for watching. The first topic, we're going to talk about the rising odds of a second Trump presidency. We're going to show you what the betting odds on Wall Street are showing and how it's being priced in. Second to that, we're also going to talk about the new rate cut probability and possibilities. Markets are sort of teasing that out. They're seeing some weaker economic data that's going to put the Federal Reserve back in play and give cover for Jerome Powell to start lowering interest rates possibly as soon as September. And then a sentiment check and see how investors are feeling as well as Wall Street. So this is a chart from Strategis, and we love Strategis, independent research firm. They both have Wall Street and policy from Washington that they produce, and they're by far second to none on the street when we see them come out. They're always in the top 1, 2, or 3 positioning on their research in terms of the awards that they win. So anytime Strategis puts something out, we always pay attention. This is one that we've been following all year, and obviously you can see a tremendous change based upon what this is showing. It's basically predicting a betting's odds have changed and which party will win in 2024 for the presidency, and the Republican nominee Donald Trump. And right now, after seeing the tragic events for this country, just in general, markets are sort of moving towards a Trump presidency, at least by way of the betting odds. This is not uncommon. We saw this early 80s after the failed assassination attempt for Ronald Reagan. He was a plus 70%, and I think he took all but one state in that election as well back then. So this is what the odds are saying. There's a lot of time between now and election day, but we'll be paying close attention to that. One of the things that the Federal Reserve is really having to do, which is this balance, and this is a chart in our morning research that I thought kind of shows it. It's basically the give and the get, right? The hard landing effect. If the lagging effects of interest rates are in one, right? It's higher borrowing costs not only for the U.S. but for the consumer. So it's slowing down the velocity of money, slowing down the economic engine. And the longer you keep interest rates higher for longer, as I've said before, you've heard me say this, the harder it's going to be, or the likelihood of something breaking in the economy and then a hard landing. And that's what the balance is. On the other side, if the Fed pivots and goes to easier policy and easing financial conditions, they could basically offset that harder landing, if you will. The only challenge is that if you go down here and you start lowering interest rates, you're going to also reaccelerate growth, which is also a byproduct of potentially reaccelerating inflation. And that's the balance that the Federal Reserve is looking at right now. Apollo gave us this chart today, the positive effects of policy and the negative effects of rate hikes, basically just showing that even though rate hikes started way back when, policy, fiscal policy, which means the Inflation Reduction Act, had a bunch of money from the fiscal government built in to go into the economy for chip spending, if you will, for other sectors of the economy. And that's what we're seeing play out right here, where even though the Federal Reserve was restricting policy by raising interest rates, the federal government was using our tax dollars to continue to stimulate this economy. And that's what you're seeing is all these dollars being spent on manufacturing. So that's keeping the economy in good, healthy standing. Now, another thing we have to pay attention to is this is what the Federal Reserve is watching, right? The core PCE. And so the key is right now they're looking for a 2% inflation target, but does it really stay down? Is it anchored down? Is it continued that downward trajectory? And that's why the Federal Reserve is saying we're going to play this as cautiously as possible, and they're going to try to buy as much time as possible so they can only have to then worry about the sort of easing cycle and not having to do this, which is what a dovish Fed could create, which is another spike in inflation. Remember what I said, 78% of the time in the history of all these inflationary spikes, it comes back again. And this is where we are today. The CPI And this is what happened in 1974 to 82. This is a second wave of inflation. That's exactly what we discussed. It's the concern and the fear on the Federal Reserve. But we still believe we're going to see a cut, in September, and then potentially one right after the election. That's our update right now. I think it's key to see what's happening in the market from a sentiment standpoint, as I discussed. We're seeing a huge rotation. Small caps are getting a bid because there's potential for the rate cut. So the Russell 2000 you saw is up 3% as we're speaking today. And then the Dow Jones Industrial Average, right, versus the tech. So Dow is up about 600 points while I'm speaking today, but the tech, think of the triple Qs, if you will, are not participating in this rally. And that's a good thing. And the reason why is money is being rotated from the tech-driven large cap rally that's taken us where we are today, and now broadening out to small caps, mid caps, and other sectors like value that hasn't seen the light of day. And so this broadening out is very healthy for markets. It's a very positive sign. So just because tech's not going up today doesn't mean it's not healthy for the markets moving forward. So just want to cue you in on that as what we're paying attention to. That's the sentiment. That's the recap of our markets, insights, and observations. Remember to like and subscribe and share with friends and family. Thanks for watching. See you again next time.